Hello, and welcome to our webinar, the 2025 Financial Planning Longitudinal Study, Insights on Client Outcomes. Before we get started, I'd like to share a few housekeeping notes. If you experience issues with audio, please check your Zoom and computer audio settings. Should that not work, try exiting and re-entering the Zoom, which will resolve many other issues. The panelists will address as many questions as possible during the Q&A session at the end of the program. Please submit your questions through the Q&A function using the Q&A button on the bottom of your Zoom window. And as a reminder, this webinar is CE eligible and attendees will receive 1 CE credit. CE will be uploaded onto your CFP Board profile within 10 business days. Now I will turn the webinar over to Dr. Michael Collins. Michael?
Thank you, Dr. Roth. I want to particularly thank Dr. Kevin Roth and the team at the CFP Board for just a great partnership in this project and appreciate that kind introduction as well. So my name is Michael Collins. I am going to be beginning the first part of this presentation today. I'm joined by my research team, including Dr. Stuart Heckman, Dr. Emily Kuchel, and Dr. Sonya Lutter. So I'm going to sort of give a background on the Financial Planning Longitudinal Study, and then we're going to hear more about the details of some of the findings from the first 2 years of this particular survey. As Kevin just mentioned, this is a continuing education opportunity, and so we're going to cover some basic learning objectives about the FPLS, and so that's an acronym for the Financial Planning Longitudinal Study. And one is thinking about some of the key findings we found based on the first 2 years of this panel study. The second is we're going to share some results in terms of how people engage in financial planning and how that is related to their perceptions of their outcomes. And then third, we're going to talk about some of the ways that the insights from these data can be used in the real world, and whether it's in your financial planning practice or in developing strategies for working with clients. So let's talk about the study itself. So first, I have to mention that this is a partnership with the NORC at the University of Chicago. NORC is a major survey firm that works on major surveys across the country, and really has been a partner in collecting these data. What's important about NORC is they're able to find us a sample of people who we can track over time, meaning each year we can track some of the same people. And we can target people who are likely to be at sort of an age and income and an asset level where they might be interested in working with a financial planner. So a key thing about this study versus maybe other studies that NORC or other organizations have developed is that we're asking about financial planning. And I should note, we're going to use terms like financial advice and financial professional. And the reality is, for a lot of regular consumers, they don't have a lot of distinctions in their minds about which is which thing. And so we're going to kind of reflect that in some of our words too. But when I say financial planning, I really mean the whole broad set of activities that people can take part in when they're involved in a financial planning process. A key thing here is that NORC has developed a panel called Amerispeak, which means they have a pool of people that can participate in these surveys. We're not getting bots. We're not getting people who are just, responding to, try to get a gift card. And the other key thing about the Amerispeak's panel is that they are pooling people over time. So we'll be able to share with you some results from people who answered the survey from both 2024 and 2025. And hopefully we'll continue this for many years in the future. So we're going to be able to continue to tell a story about how people respond over time. So here's the key thing to be thinking about. And so we so far have 2 years of data, 2024 and 2025. We're currently planning to launch the 2026 wave, which will be in the field this May. But imagine somebody who answered the survey, the FPLS, in 2024, and then again in 2025, but in between, they got married. Well, we can see what that means in terms of their answers to key questions about how they're living, their financial well-being, and what they're doing. And so we're going to talk a lot about different measures that we have, including wealth, including other kinds of activities that we can measure. The other thing we can do is look at people who both say, yes, I work with a financial planner, financial advisor, financial professional, as well as they who say they do not. And so we think about these people as the unadvised versus the advised. And over time, we might see people who say, in 2024, I was not working with an advisor. But then in 2026, actually, it looks like I now say that I've hired a CFP. I have a certified financial planner. And then we can see relative to their outcomes in 2024, what they look like in 2027, 2028, et cetera. So this panel nature, this repeated opportunity to hear from people and hear about their outcomes and what they're doing is a real key part of this survey. And we couldn't do that without the AmeriSpeaks people panel from NORC. So just a little bit about the sample. So we are not trying to capture a representative sample of every person in the United States. We're really focused on what you can think of as sort of peak working years. So age 25 is about the age when most people have completed the majority of their schooling up through around age 65. So about the age that people start beginning about thinking about leaving the workforce. Now, if you entered the survey in 2024 and you were 64 years old, we're going to keep tracking you well, into your 70s, hopefully. But that's kind of the starting point that we're going to look at when people enter the survey in each year. We're looking at a minimum household income of about 50,000 and then investable assets of about 30,000. Again, once they enter the survey. Everybody in the sample has at least a high school degree. And we also are asking for people who are either the primary financial decision maker or a shared decision maker in the case of a shared decision maker household. Um, Everybody is either recently retired or currently employed, meaning they were employed just until recently. And we started out last in 2024, I guess 2 years ago now, with our first sample that was collected in July with about 4,000 people. In 2025, in May, June of 2025, we collected about 4,500 respondents, of whom 3,500 and 3,357 were from the first wave. So about 83% of the people that we surveyed in 2024, we also got in 2025. And then we added in about 1,200 new participants who will then be part of this panel. And so each year we're going to have some added, some dropped, but we're going to have a core group of people who respond over multiple years, and we can track in that sort of longitudinal way. And that's really what makes this such a powerful data set. Next slide. All right, so here's one of the core things we're thinking about, which is we ask people, do you use a financial professional? And we say a financial professional includes, advisors, planners, all kinds of different things that people could be working with. And about two-thirds, 67% say they do not, and about 33% say that they do. Of those who say that they do, the 33% who say that they do work with a financial professional, 51%, about half, say that they are certain that their financial professional has a CFP. And we say in our survey questions, a CFP might have on their business card the letter CFP with the trademark. So we try to really make sure that people are getting a good sense of what we mean by CFP. About 41% of those people who say, yes, I use a financial professional are uncertain if they actually have a CFP. So as I go forward on these slides and Sonya goes forward on the slides, you're going to hear us talking about people who are unadvised, people who are advised but not using a CFP, and then people who are using a CFP. When we say that, we mean certain about using a CFP. When somebody says they are certain that they have a CFP, that's what we're defining as working with a CFP.
Thank you so much for setting that stage, Michael. And I am now going to go into some of the advantages of using a financial planner and kind of letting you know how we conceptualize this study. So I want you to imagine with me for a moment that a client or a friend has just called you and they're asking if they can go on this really nice tropical getaway, escape the winter that we have been experiencing over the last few weeks. And this person has $2 million in their portfolio. So the question is, why are they calling you? That money element is one third of the picture. That's the resource management. They are doing good objectively. Of course, they can afford the vacation. There's no need for them to call you, except when we look at a person's financial wellness, it's also taking into account how they are thinking about money. Who are they comparing themselves to? That peer comparison element. What sort of anxiety might they be bringing into the conversation? How do they feel about money? How content are they? So when we look at financial wellness, we're looking at all three of these components. And knowing that people are searching for financial wellness, if you do any sort of AI check for why are people hiring a financial advisor or why should I hire a financial planner, you're going to see it pointing towards wellness. This is a key element that we are looking for. So when we look at the most important finding of this entire study so far, it is that hiring a financial professional definitely improves financial wellness and it improves it in how people are doing with their money and how they're thinking about their money and how they're feeling about their money. So in this first chart, we can see that CFP advice clients are objectively better off than those two other categories that Michael referenced. The people who have a financial professional who they're not sure if it's a CFP professional or they're sure it's not a CFP professional. And then we have this whole group of unadvised clients within our sample. And here what we can see is the CFP advised clients are above average. That's that dotted line on both of these characteristics of resource management. They are much more, 10 to almost 30% more of them are in the having an emergency fund. They are prepared in the event of something going awry, and they are more likely to have a will compared to the other groups. We see similar patterns here of CFP advised clients being better prepared for financial instability. We've got the disability insurance over on the left, and then we're looking at elements of life insurance on the right. And you can see it's the same pattern to where the advised clients are also above average in terms of being financially prepared. And yet the CFP advised clients are even higher on that being financially prepared. Moving towards financial well-being, the CFP advised clients feel better about their situation. And yet some of them are still going to call you about that vacation because their perceptions may not align with that resource management stuff that we just covered. Here we see that one half of the CFP clients strongly agree that they're living comfortably. And this is roughly 10% higher than the advised group and almost 20% higher than the unadvised group. So this is looking pretty good for the CFP advised clients. And don't get confused by the right chart. I switched the categories on you. So here we're looking at the percentage of these three groups that disagree, strongly disagree that they have too much debt right now. So it is indeed the same pattern that 39% of the CFP advised clients feel like they do not have too much debt right now, compared to 23% of the unadvised clients. So another thing to note here is differences in some of these years from 24 to 25 and the improvements that you might see along the way for those three groups, or maybe not improvements for those three groups. We also asked in terms of financial well-being a series of questions about feeling content with your financial situation, feeling secure, feeling success when you think about your financial situation. And CFP advice clients report about 1 to 2 more positive feelings than people in the other two groups. And there's a nice pattern on the right for feeling satisfied with their financial life. But if you look at this, it's the percentage of people who are saying that they are completely satisfied with their financial life. There is room for improvement across all three of these groups. It does not look super great for the people in the unadvised group. About 7% of them in 2025 were completely satisfied with their financial life compared to 18% of the CFP advised group. But there's a whole lot of room for improvement past that 18% to help our CFP advised clients. There was a slight decline from 24 to 25 in the other advised group, but generally we're seeing some nice patterns here still for the CFP advised clients. Now, I want to show you a little bit of a preview of what we're working on for financial wellness. So we know that people can be objectively well and still experience a lot of anxiety. So, what we're trying to get to is an overall score of financial wellness that combines these elements of resource management, of psychological, social condition, and financial well-being, how they feel about their situation. It's the combination of all of these things that is predictive of a person's indicative of their financial wellness. And so here are the items that we have included within each of these three areas that together make up financial wellness. And it's not that any of these categories are more or less important than the others. Besides that, we still need to pay attention to those objective measures. We still need to know about a person's estate planning, their basic financial management, their tax preparation, and tax liability. We still need to know about their insurance coverage. Are they on track to meet their retirement goals or are they not? All of that very important. And so is jumping to the right side, the financial well-being elements of feeling satisfied about their financial situation. And I think we do a pretty good job on both of those, maybe some room for improvement on the financial well-being, asking people more directly the feelings that they attach to money. And yet there's this middle column that has not been well addressed before. That's really a key element that we're able to track over time. So far, we can track it from 2024 to 2025. And going forward, we will be able to look at some of those indicators that Michael mentioned with, let's say a person gets married in between waves. What do we know about their psychological, social condition and overall financial wellness? Or let's say they experience a death of a loved one. How does that influence these various areas of financial wellness? So within that psychological, social condition, we are looking at how people are comparing themselves to other people around them. So that peer comparison element, definitely very important. We're also looking at the conflict that they might have with their family around money, the anxiety stuff, and also capturing some elements of physical and social health along the way. So let's say that was really fun for you, and now you want to know, how can I use this financial wellness assessment? I hope that was the question that you had. And soon we will have this available if you want to use the full assessment. But ideally, your CRM or other planning software is already capturing elements of wellness. And maybe you identified some of those things that you hadn't previously thought of as holistic financial wellness. But if you're not capturing that data already, perhaps start asking some questions about their feelings towards money or maybe prior experiences with money or various life events. And then at some point, maybe introducing them to the full financial wellness assessment could be a really big deal in measuring people's change over time and really highlighting that value of financial planning. We have demonstrated that there's a clear value in financial planning, even more so for people who have the CFP designation. So, why are people not hiring a financial professional? Who are these people? At a baseline, none of this is going to be a surprise to you that the unadvised participants tend to be a bit younger. They're more likely to be single. They have lower financial literacy scores. They are more risk averse. They have lower income and assets, and they're less socially active, which perhaps seems a little bit off course in terms of what you might think of in terms of identification of a group that's not seeking financial planning. But it is a really big deal because we see later on that social interactions are very informative in that referral process. And referrals are the number one reason why people are seeking financial planning. So it's good to know how they're interacting with their social environment and perhaps thinking about that as a way to target this unadvised group. Just to help you remember, there's 67% of the sample who's not currently using a financial professional. And of that 67%, we see that a third of them are looking towards digital resources to get their financial information. So if we want to capture more of that unadvised market, what a brilliant opportunity to go where they're going and get in front of, on the right side, more social media that's targeted for the end consumer, not for us with other financial professionals, but that's targeted directly to the end user, and maybe producing more newsletters or getting in your local newspaper or other outlets like that that might be pointing towards things that get posted on social media and or other digital resources that might be available to them. Also, we asked this question. This is one of my favorite questions in the whole survey. And we asked, how familiar are you with how financial professionals are paid? This is capturing the percentages, the percentage in each of these three groups who are very or extremely familiar with how financial professionals are paid. 39% of the unadvised group has an idea of how financial professionals are paid. Huge opportunity to increase the price transparency here. And that in and of itself could be enough to help them understand that this is a value add for them. And maybe they have some idea that it's even more expensive than they can afford, which may not be reality. Still a little bit shocking that 85% of the CFP advised group are familiar. They've already hired the financial professional. 63% of the advised group have also hired somebody, and they are reporting only 63%, and only 85% are reporting that they're very or extremely familiar with how their financial professional is paid. Other opportunity here, these are the factors that are important for selecting a financial professional, if one were going to hire one or if they had already hired one. And we see that designation and education is a big one for CFP advised clients. Top two for everyone across the board is being recommended. I said that was a big thing, that social connection. So over half of the sample say that those two things I mentioned, the referrals and the clear price transparency, were important for them if they had already hired or if they were going to hire a financial professional. And these two areas are especially important for people who are using a CFP professional. They said that the strong designations and or educational background and being specialized in an area were important features for them. So if we want to attract more people, let's highlight some of those characteristics in ourselves. Just another note that's not up here on this slide, only 10% of the overall sample said that an advertisement prompted them to hire a financial professional or would prompt them to hire a financial professional. So for what it's worth, perhaps some of these other things would serve us better in that regard. And now I want to know, we know what people are looking for. We maybe know some ideas for how to target those people, but let's dial in on what makes CFP professionals special. Huge one. One of my other favorite pieces of data from this, from the FPLS. Let's look at the widely used metric. It's the Net Promoter Score. And the question, I'm sure you're familiar with it, says, how likely are you to refer your financial professional to friends or family? And the nines and tens are the strongly agree. These are our big fans over here on the right side. And then we have our people in the red, the lower side, who are more of our detractors. And the NPS is simply the percentage of people who say the nines and tens minus the percentage of people who are reporting the 1 through 6. And so, of course, you get a scale of the negative 100 to positive 100. These are really good scores. Plus 40 for CFP advice clients is it's ridiculously high for people within our industry and almost twice as high as other financial professionals. So this is a really big deal, and I think it's pointing towards the trust that CFP advice clients have in their financial professional. But we can also pick out a little bit more information of what might be getting people into that promoter group versus the detractor group. These are a couple of the areas that are more true for the promoters on the right side versus the detractors on the left side. Specialty area, we see it once again. This is true for 46% of the promoters that that specialty area is important for them. And then secondly, more true for promoters than detractors that their advisor shares a similar background to them. So this question was much more extensive and asked about their cultural background, their racial background, gender, um, other characteristics that helps the client feel like they have a similar background to their financial professional.
Great. Thank you so much, Dr. Lutter. So we've now heard a little bit about the differences that we observe between these what we're calling CFP professionally advised clients and the clients who say that they have a professional, but they're not sure if it's a CFP professional. And so I saw some questions in the chat about how do we really know what people are trying to report. There is a lot of confusion in the marketplace. We don't deny that. We've tried different methods of trying to make sure that we're narrowing in on the characteristics that would be more identifiable with CFPs. And we've actually done some further work outside of the survey to try to get a better handle on that. Certainly, there are some people who are going to be incorrectly identifying a CFP and vice versa, but it's a pretty low percentage. And the majority of people who say that they're certain that they have a CFP actually do. So one thing that makes us feel a little more confident in these designations is if we compare the activities that people who work with a financial advisor, financial professional, report engaging in as part of their financial planning. So we would expect that people who have the CFP designation would be more engaged in some of the issues that they're taught to do as part of that CFP certification. So here's some examples of differences between the percentage of people who strongly agree that their financial professional learns about their family and values. It's 41% of the non-CFP advised and 60% of the CFP advised. That's a pretty big difference. It's statistically significant given our large sample. Similarly, that's almost a 20-point difference. There's also almost a 20-point difference to the question about learning about my partner's relationship with money. It's the idea that a planner or advisor would be engaged in thinking not just about the primary person, but about who else in the household might be there. So again, 20-point gap, 37% versus 57% for the CFP advised. Sonya earlier talked about some of these aspects of financial well-being, some of which are around emotions around money. So people who strongly agree that their financial planner or advisor lessened their anxiety. It's 38% of the non-CFP and 59% of the CFP advised. So these gaps are pretty consistent. And we have another question about my advisor motivates me, 34% versus 54%. Again, 20-point gap. And then another large gap with I trust my advisor. There's significant differences between people who report that they're certain that they have a CFP advisor versus those that don't. These are all statistically significant. We can control for factors like income and assets and age and all kinds of other things, and we still see persistent differences between these groups. So we do think that CFP, that response to that question about the CFP designation does seem to have some validity. So let's turn now to thinking more about what are the interactions with these CFP professionals like? What kinds of activities are they engaged in? And what's nice about this survey is we're able to each year ask slightly different questions to try to get a handle on what it is that we're seeing clients reporting that they're doing with their financial professional or with their CFP professional in the other case. So here's some categories that should be familiar to you as a CFP. These are sort of these core competency areas that is expected among a certified financial planning professional. And what you see here are the differences. So if we took the percentage of the non-CFP clients and the CFP clients and look at the difference. So these are all positive, meaning that the percentage point difference between the two groups is advantaging the CFP professional. And so this is, the question is, how much detail do you and your financial professional go into regarding each of these areas? So the first one is the psychology of financial planning. There's an 8 percentage point higher rate of people saying that it was very detailed when they are certain that they're working with CFP professional. For tax planning, it's a 9-point differential. So people who have a CFP designated advisor say that they are very detailed in their tax planning at a 9 percentage point higher rate. Retirement planning, most financial professionals address some aspects of retirement planning, and yet even here we see a 10-point differential in favor of the CFP professional. Estate planning, again, not a place that some people go to for every planning activity, but here is an 11-point advantage to the CFP professional. Risk management and insurance planning, a 13-point differential. And then finally, investment planning, a 15-point differential. So again, this is consistent with the priorities of the CFP designation, the training, the credentialing, all kind of consistent with factors that we would say are, again, reassuring that what we're measuring actually is the CFP designation and that differential that people are seeing in those relationships. All right. I've already seen this question in the Q&A, which is, yeah, fine. CFP is nice. Maybe it's just that people who go to a CFP are the people who they're already older. They're the people who already have professional degrees. They're the people who have more assets. They're the people who have more financial. It's all the things that we can imagine that drive people to go to work with a CFP or to work with a financial planner are the same things that make their financial well-being measures that we just talked about better off. And you're exactly right. So we are not in a randomized trial. We're not a pharmaceutical company. We can't go out and find a random sample of people to randomly assign to working with a financial planner or a CFP, or I don't even know what the placebo would be in this case. If you have a good idea for what the control group would be for a study, please let me know. So what we've tried to do instead is we have data that is observational in nature, but we do know a lot about the respondents. And so one thing we can do, and here we're just looking at the people who report working with any financial planner advisor, regardless of whether they're CFP or not, to those who say they don't. So recall back when I sort of give you an overview of the data, it was roughly 2/3 of the respondents say they do not work with any financial planner advisor professional, and about 1/3 do. So what we can do is take that 1/3 who say that they are working with a financial professional and compare them to the group that aren't. And so what you see here in these gray bars, the lower of each of these groupings here, is the differences for these financial well-being measures that Sonya talked about earlier. And the first one is actually a composite of all three of those different areas. So the first top row is the overall, which is just a sum of each of the lower ones. So resource management, psychological condition, and financial well-being. And you can see those gray bars are positive. So we see a larger gain in each of the scales for people who report working with a financial advisor. But like we said before, these differences really are, probably not fair because it might be other things causing that, whether it's assets or income or something else. So what we can do is something called matching. So this is a statistical technique where you take people and you put them into kind of bins of other people like them and then compare them. So in this case, we're taking people matched within state, so within the same state of a similar age, with similar asset levels, with similar income, similar household size, So as much as possible, we're matching one for one or like for like within each of these areas. And that's those matching based estimates are what you see in the yellow. Now, typically, when we would do some kind of a matching exercise in statistics, it often will the results are going to get smaller or closer to zero because you're just really winnowing down other factors. We actually see the opposite in our data. So we see a larger relative marginal impact of working with a financial planner advisor on the overall scale, and then on the resource management scale, the social condition scale, and the financial well-being scale. And we actually see some of the biggest differences on the psychosocial. So some of the stuff that's not related to things like where you live and your wealth and those kinds of things. So um, does this prove that working with a financial advisor makes people better off? Certainly, I wouldn't go that far, but this is a pretty robust test. This sort of matching estimators are a pretty robust way to match that. And I would say it gives us a little more confidence in the findings that we're seeing. And the other important thing is that when we do the matching, the results in terms of the differences between the two groups get larger and not smaller. So we're not conditioning away the factors that might be involved. We're actually making our results even stronger. So we take this as a very positive signal that these differences might hold up over time. We could take this even a step further, and this is going to get a bit nerdy, but there is a technique in statistics where you can kind of use other factors that probably aren't related to people's finances to predict whether or not they use an advisor. So one of the factors that you can use is whether people live in a state that has high estate taxes. They live in a state that has fiduciary laws. They live in a state that has other kinds of laws and attributes that probably people didn't move to that state because of their fiduciary laws or some other piece. Um, but it might be actually a factor that influences whether or not they work with an advisor. Another key thing we can look at is how many advisors are there per capita in a state. If you're living in a state that has more advisors, you probably didn't move to that state because it has more advisors per capita, but it does make it more likely that you actually use an advisor. So these are all things we can do to predict whether somebody has an advisor or not. This is called a two-stage least squares. If you're interested in the nerdy part of this, it's an instrumental variable to predict whether people use a financial planner or not. So these results are much larger in nature, and that's partly the nature of these predictive models. But importantly, these results hold up. So we're still seeing positive impacts of working with a financial advisor in all of these different models, which again doesn't prove that we have a causal relationship here, but certainly is consistent with the kinds of models that we've been thinking about.
Thank you, Dr. Collins. That was nerdy indeed, but also so interesting and informative that everything that we did prior to those few slides still hold up. And that's a pretty cool thing. Also, you mentioned Dr. Collins early on about have the opportunity to ask different questions in each wave. Most of the survey is consistent year after year, but every once in a while we'll switch up some questions. And even prior to that, we will test out the questions to make sure that they're going to work before we go all in with the FPLS data. And one of the ones that we had looked at was that peer comparison question and framing it in terms of positive psychology. Of course, those of you who know me know I'm very passionate about that. And this is really cool information. There was the question, are you doing better off than your peers financially these days? Or the alternative way that we ask the question is, are you feeling worse off than your peers financially? And so in this pilot data, we were able to split the sample and give half of the people the better off framing and half of the people the worse off framing. Remarkably, how people responded to the next several questions was different based off of the one word difference, better versus worse. The people who were presented the option of, are you doing better off than your peers financially? They were more likely to say that they're using money to create joy and happiness in their life. They were reporting more of those positive feelings about their financial situation, and they feel like they're managing better. And the only difference was that one question. So, what is this saying? we, as financial professionals, serve as a bit of a coach. And there was the question that Dr. Collins mentioned earlier with their advisor motivating them to achieve their financial goals. We see much higher rates among those CFP advised clients, 20% higher than the unadvised category, or the other advice category. And what that's saying is that how we present that information, encouraging and more of the positive frame, getting away from what's keeping you up at night and framing it more in terms of what are your dreams and aspirations. It really does make a difference in a person's overall financial wellness. And we held everything else constant. So these people were not saying that they used money for joy and happiness because they had more income to deal with. These two groups of better off versus worse off were the same. They were the same age, they had the same income, they had the same asset level, and they had the same financial literacy level. So it's really pointing toward this opportunity for financial advisors to be more of a coach and help with some of that framing for the clients to put them in a positive mindset. So, as we get into your questions, the bottom line here is this is a story about trust and confidence and impact. The CFP board has produced this really nice report that's on our client impact study website that you can read and get some of the information that we presented today. Of course, we presented more than that. And certainly there's much more data available that can be gathered from the data. We would very much like for those of you who are researchers on the call to use the data, and knowing that those CFP professionals are rating higher in all of these categories, help us understand why and dig into the data. How you get the data? Right here. Go to the QR code. Not only will this take you to a place where you can download the 2024 data, the 2025 data will be online in 1 month on March 2nd. So you can get that data very soon as well. But I have not been looking at the Q&As. I am certain that one of the questions is, can you have the slides or the presentation? It will be there too on the same website. So bookmark that page and you can get all of the different descriptive reports that we have done and other important information about the study. So with that, we wanted to leave plenty of time for questions. I hope you all have some good ones for us. I'm going to invite our other research colleagues to the conversation. And maybe Stu, I'll have you fire away with some questions.
Yeah, thanks so much. We had a ton of questions. That felt like a sprint. I was trying to respond to a bunch, so sorry if I didn't get to your question. Lots of really good questions. So let's start with a couple. I'll emphasize again that the website has reports about our methodology, transparency report from our survey partners at NORC. There's also each year that the survey comes out, we're going to be publishing a descriptive report in Financial Planning Review. And so in the Q&A, I did link a few responses to that article from the 2024 data. But let's start with this question. So we've been running the data, collecting data now for 2 years. We're gearing up for the third. There was a question about what survey results surprised you. Were there any items that were surprising in the sense of how CFP professionals compared to other professionals? Why don't we start with that?
I'll share something that was not in the slides, and some of you have heard me talk about this before of the relational advantage of using a financial professional. And it's clear, it was clear in 2024 and it was clear in 2025 that people who use a financial professional also experience higher relationship satisfaction, marital satisfaction, And that's a pretty big deal. And the gain in marital satisfaction, relationship satisfaction is even higher for people who are using a CFP professional versus a different type of financial professional. For me, that was interesting, not surprising because I kind of expected that to be the case. But what was interesting with that is the number of CFP advice clients who said that their financial professional was incorporating psychology of financial planning. Still a relatively new competency domain, but it was remarkably higher for the CFP advised versus other advice, and that people even knew what that was and that they were looking for it is an interesting thing.
Yeah, that's great. Dr. Collins, I have a question for you. There was a question about what some of the numbers meant on, especially around financial well-being. So there was a specific metric that was being asked about. Could you give us some sense of, especially, I'd say those multivariate results that you were kind of previewing? Um, what was the scale? How should people interpret that, 6.5 boost on financial well-being, for instance?
Yeah, no, I love the nerd questions. So thank you. This is fantastic. So you notice on this slide there are basically 18 survey items that are measured. So each of these columns, we can basically aggregate these up into a scale. And we basically normalize that scale around 50 as being the average. So it can go as, close to zero and close to 100, but 50 is kind of the average. And so and then we can take the three scales together and weight them all together. And again, it's just a 50-point scale. I'm sorry, 100-point scale with 50 is about that average. And so a lot of those results that you saw and so I don't know if you can scroll down a few slides where we look at the differential in the score. It's actually the difference in the score controlling for all the other things that we talked about. So controlling for age and income and assets and all the rest. So it's a percentage point difference. I'm sorry, a point difference, not a percentage point. It's a point difference where you can think about the average as being about 50. So a couple more down, sorry. Um, Here. So on an average of about 50, in controlling for all the things that I talked about, they're about 4.4 points higher. So that's about, if you want to think about that as a marginal effect relative to the average, it's about a 4.5, 5% greater difference for that group. So again, these are with sort of thinking about relative to a overall average of about 50. That's the point gain controlling for all the stuff that we talked about. I hope that makes sense.
Yeah, that's great. Thanks. Um, Real quick, I'm seeing a few other questions, so I might just address a couple. Another question that we've gotten a lot whenever we talk about this project is a question about what about other designations that the advisor might have? It's a great question. We do not, in the survey, ask about additional designations. We are piloting some things maybe on the advisor side, and this relates to a number of other questions that I think a lot of you are curious about. Well, what about firm characteristics and more characteristics of the advisor? Great questions. This survey, because it's centered on the client consumer, and what we've learned is that people generally don't know the advisor characteristics all that well. So we're pretty limited in what we can know about the advisor at this point. Another question that came up really early on was about AI tools. And I was hoping, we've been having conversations around survey items related to AI and how people might be using those, but would either any of you like to address information sources, AI, and how that is going to impact what we're doing in this collection going forward?
I guess I would just quickly note that it's something that we have, as Dr. Ackman noted, it's something that we've been talking about as a team. It was something that came up as we initially started talking about some of our results. And so it's what we've started adding into our survey as a question. We too are curious about how it could potentially be impacting services provided, how people are using it as a resource for themselves because they could be coming in equipped with that knowledge as well. So it could also be affecting some of that selection and other things. So we too are looking at opportunities to start to build it into our survey. But as Sonya noted at the end of the presentation, would be a great opportunity for you to also present some of that feedback. We'd be curious to know, how is that showing up in the work that you're doing? What are some of the curiosities that you have around AI? We'd love to hear your feedback so we could potentially implement that into the work that we're doing as well. So great opportunity for you to get involved.
Yeah, we really do consider those questions when we receive suggestions about the survey. Of course, there's limitations to how many questions we can put in the survey, but we do really consider those as as the survey evolves going forward. Another question, Dr. Collins, I might go to you, and this might have been in the slides. A question came up around financial literacy and how financial literacy may play into the decision of whether to hire an advisor. Could you speak to that a little bit?
It's an excellent question. For sure, people who work with an advisor tend to have higher financial literacy. So the way we measure this is with a very standard question it's a set of 5 questions. It's a quiz that's commonly used in a lot of surveys. And so people who do well on that quiz are more likely to have an advisor. It's pretty similar between the people who work with a CFP advisor versus a non-CFP advisor. Um, so one of the key questions for us, though, is whether does having a higher level of financial literacy drive people to seek out an advisor, or does working with an advisor help improve their financial literacy? Do they score better on the quiz because they have more knowledge because they're talking to a professional about their finances more frequently? We don't really know the answer to that question. It is also true that financial literacy scores, these answers on these quizzes, are highly correlated with people's age. So people in their 20s and 30s tend to do pretty poorly on this quiz, and people who are older tend to do better. So it's kind of an open question for us at this point in time. What we're beginning to see, though, with the panel, now we just have 2 years, but we can look at people who have gone from not using an advisor to using an advisor and then look at their financial literacy scores. Do they do better on the quiz after working with an advisor? So that's beginning to give us some evidence. It's just 2 years, but beginning some evidence that actually they are, doing better. They're scoring better on their financial literacy after that engagement with an advisor or professional.
That's great. Thanks. There's been a handful of questions around, what reports might be available to use in conversations with clients. So I think I'll just mention that our CFP board puts together reports based on the data. We put together, especially the maybe more boring academic reports, but then a lot of that data does show up in some of the reports that they're creating, and so I'd recommend following the website. And yeah, thanks for putting that link there to see what materials you might find helpful. All right, I'm scrolling through questions here. Anybody else see any questions that they wanted to address?
I'll post just one quick one to Dr. Lutter. There were several that were brought up regarding the financial wellness assessment, financial wellness score, and you had mentioned the opportunity to maybe use that through a technology or other kind of services. Several questions about whether that assessment is available currently or when they should, or opportunities to use that. So we wanted to see if you could speak to that further.
Yeah, I'm glad that people are interested in it because it is a really neat thing to be able to look at people's overall financial wellness. I know we talk about that a lot in terms of holistic well-being, but what does that actually mean and how are we going to measure it? I think the example of the client who calls and asks if they can do something or buy something is most obvious. I think we've all experienced that either with a friend or a family member or a client. And it really speaks to that disconnect between the resource management side and either the psychological social condition and or the financial well-being side. So some of those questions definitely are things you're asking about already. Certainly, you're asking about debt. Certainly, you're asking about unexpected taxes that the person might have owed. You, of course, have an indication of retirement readiness. But then these other pieces, maybe you're asking, but not as directly. So that's where I'm saying the full assessment is certainly useful as an intake questionnaire, but we get a lot of questionnaires. So if you have the opportunity to maybe start asking about some of these other things, you can get a pretty good picture of a person's wellness. So if you start asking them, when you think of money, do the following things describe how you feel about money? Do you feel prepared? Do you feel content? Do you feel confident? Do you feel like you're managing well these days? And sure, those seem like obvious questions. Of course, they feel like they're managing well. They have a $10 million portfolio. That's not necessarily the case. So asking the questions most directly, yes, you could ideally capture some of this within your planning software. I haven't seen any planning software that has all of those pieces in it, especially the financial socialization elements, that middle column. So that's why we created the assessment. And uh it is complete. We have the data, as Dr. Collins mentioned. We have done a lot of different types of analyses and feel really good about where it is right now. It's just not yet published. So if you follow our client impact study website, we push out information there. The CFP board also is pretty active on social media, so I'm sure you'll see it there as well. I might just say something while you're looking for other questions.
Sure.
With what Dr. Collins was saying with the how we can capture and do more of that causational research of not having an advisor. We already have a group of people who have now hired a financial advisor and conversely who have fired the financial advisor. So that does allow us to see which came first. To a certain extent, this is not truly experimental, but we can see some of those difference in financial literacy, but also the relationship side of things. I know I always come back to that, but it's really interesting to me to know what is driving this increase in relationship satisfaction for couples who are going to a financial planner. And we're able to get to some of that as we go through these additional years of data collection. We will be launching the 2026 data collection very soon. And so about this time next year, those results will also, or that data will also be available for you to use. And I don't know that we can emphasize it enough that we really do want everyone to use the data because there's only 4 of us and we can only do so much. So get in there and start using it.
I'll just throw out, there's been questions about can we see any difference in investment returns between these groups? And I think the reality is it's very hard for people in a survey like this to answer detailed questions about their portfolio, adjusted for risk. I mean, it's a Sharpe ratio. I mean, how do we even think about measuring these kinds of things? So I don't think we're ever going to have a great measure of investment returns. I mean, in fact, what we see from people's responses is that they're more interested in the reducing their stress and worry and about the planning aspects than they are in absolute returns. And so, we're going to continue to ask questions about both financial and non-financial aspects of people's lives. And so hopefully we'll get some more precision around this over time. But in terms of really knowing, a point estimate of what's the extra boost in terms of investment returns, I'm not sure that we're going to get there with this survey.
Awesome. On behalf of our entire research team, thank you all for coming. This was really fun for us to get to share some of the results with you. There's a lot more out there, and we hope that you will continue to follow along. Thank you.
Thanks.
Everyone.